Hey, welcome back to the channel. I am Jeremy. I'm the Stock Brother, and you're on the Stock Brother channel. You are welcome back today. We are going to get into a subject today that I have been asked some questions about. We are going to talk about share dilution today. I did a video a little bit ago about shares outstanding, and I was asked to actually do a little bit of elaborating on shares outstanding. And I had already had the share dilution video kind of coming, so I figured we kind of mix these together and try to get a better view of share dilution, and also, really the pros and cons of share dilution, and also try to give you a better understanding of shares outstanding as well, and how it affects the shareholders. So, and that's what we're going to do. We're going to talk a little bit. I'm going to give you a definition, first of all, about what share dilution is. Then we're going to get into a few reasons for share dilution, or why a company might dilute their shares. And then I'm going to give you a few slides, a couple of things that you can kind of look at that will maybe help you get a better understanding when it comes to understanding share dilution and understanding shares outstanding, so you can understand what you are actually buying when you buy these companies. So we're going to, that's what we're going to talk about today. So you all, if you haven't been to the channel before, please subscribe to the channel. Thank you very much. Go ahead and hit the thumbs up button as well. Turn that blue. And for the most part, thank you for coming in. Don't forget to hit the notification bell, and that will let you know every time I put another video out as well. So y'all, let's get into this. So what is share dilution? What share dilution, or equity dilution, or stock dilution sometimes it's called as well. It's called all of those three things. It is basically, it's a decrease in the existing shareholders' ownership percentage of a company. Most of the time, it's as a result of the company issuing new shares or new equity, basically putting more shares out there for people to buy. That's going to be exactly what share dilution is. It's basically the decrease, again, of an existing shareholder, somebody who already owns the company. It's a decrease in the percentage of the company that they own already. That being said, now we're going to get into some reasons why a company might dilute their shares, or why you as a shareholder might experience share dilution with a stock that you bought, or with a company that you bought into, why you might experience share dilution. One of the first reasons why you would experience share dilution is because if you own that stock already, and the company might want to raise capital or raise money. For whatever reason they might have that they need to have money for. Of course, a company has to have money in order to grow its business, or whatever it might be. So if they want to raise capital or raise money, then they will issue more shares or issue more equities. In that case, when they issue those equities or put more shares out there for people to buy, it in turn dilutes your equity, or dilutes the amount of the company that you own. And we'll get into that a little bit more here in just a little bit to try to give you a better understanding of what I'm saying. But that's one of the first reasons why a company might dilute their shares, or why a shareholder might experience share dilution or equity dilution. One of the second reasons why you might, or why a shareholder might experience share dilution, is from a merger or an acquisition. A company might have another company that they want to merge with or combine their businesses together. So they might issue shares to the other company as an enticement to have them go ahead and do the deal, to come in and merge with their companies. Also, with acquisitions, that's basically a bigger company trying to buy one company trying to buy another one. The bigger company a lot of the times is buying the smaller company. So the smaller company, or the people, the executives and everybody at that smaller company, don't want to just sell the company for nothing. So what a larger company might do when it comes to an acquisition is issue shares to the other company as a method of payment, basically to pay for another company to put it with their business. The third reason that you might run into share dilution is because of any kind of employee compensation type plans. Most of the time, this is given to the executives of the company, and they will issue shares to the executive for whatever, for bonuses or whatever it might be. They will issue these shares out to executives. They also will give it to founders of the company as well. People that were there from the beginning and started the company, they will issue shares to those people as well. So that can cause share dilution for the existing shareholder, for you and me who already own the stock. If they choose to give out more stock, then it means we own less of the company than what we bought originally. Also, companies will issue convertible securities or stock options as well. And we won't go into those too much, but these are basically options and securities that they will issue to executives and to other people, that you have, those particular buyers have the option of converting these options or these securities into shares as well in the future. So it doesn't necessarily dilute it as soon as they issue stock options or convertible securities, but it could possibly dilute your shares in the future if those are converted. So keep that in mind as well. Okay, now you all, I want to get into some slides here just to try to give you a little better view of what I'm saying, a little idea of what I'm saying here. This first slide is going to be a slide that kind of shows you what a company might look like if they have two founders, and they have 1,000 shares that they have issued out. One founder has half the shares and the other has the other half of the shares. So they both have 50% of the shares. Founder number one has 500 shares and founder number two has 500 shares. Now getting into this next slide here, this next slide is going to show you after the dilution happens. Now in this particular case, the company itself decided to issue out 200 more shares in this case. So when they issued out 200 more shares, it raised the shares outstanding from 1,000 to 1,200 shares. And as you can see the percentages here on the slide, once those 200 shares were issued, founder number one still had 500 shares, founder number two still had 500 shares, and then the other 200 shares that were out there are for other people to buy. So now, instead of it being 1,000 shares outstanding, there's 1,200 shares outstanding. So that kind of gives you an idea, and here you can kind of take a look at it side by side. It kind of gives you an idea of the 1,200 shares outstanding that they have now, and gives you an idea of the whole pie or the whole company and how it's actually split up because of share dilution, because they were issuing other shares. So it kind of got split up. Now, jumping over here to this other slide I want to show you here. This is just another pie chart that's going to give you an idea of, try to give you a little bit better idea of share dilution and your ownership stake and what you actually buy and what you're actually getting when you buy a share or when you buy a piece of a company. So in this particular slide here, you'll see that, we'll just use this for example. We'll say that a company has 10 million shares outstanding in this first chart here. And you, as a shareholder, you own 1 million of those shares out of the 10 million shares that they have outstanding. So that means that you are a 10% owner, or you have a 10% ownership stake in that company. You own 10% of the pie. Now, on this next slide here, this is an example of the company that you own actually issuing another 10 million shares. So with them issuing another 10 million shares, you only own 1 million of those shares. You still own the same amount of shares that you had before. But with them issuing another 10 million, now they have 20 million shares there. And because you only own 1 million of the 20 million shares that are outstanding, now your ownership stake or your ownership percentages, it shrinks to 5%. And that is a prime example of share dilution. When they put other shares out or issue more shares, the shareholder, the existing shareholder, loses a percentage of the company or loses a percentage of the value that they bought originally when they purchased those shares. So you can see how it could be a bad thing when you talk about diluting shares. Now this last slide I have here for you is just kind of putting these side by side so you can kind of see a 10% stake in a company go to a 5% stake in a company just as quick as they can issue more shares. Also, there have been a lot of different splits when you talk about Apple, Tesla, a bunch of different splits that are going on, and people don't necessarily understand exactly what the splits do and how they do. I do have a video where you can go check out that's called Understanding Stock Splits, Reverse Stock Splits. You can most definitely check that out and get a better idea of a stock split. And I want you to understand, it's not all bad every time a company issues new shares or dilutes their shares. If a company issues more shares and they take the money that they gain to better the business, to grow the business or make improvements when it comes to research and development, when it comes to buying assets, or when it comes to investing the money in short-term investments or even long-term investments, or even if they do issue shares for an acquisition, for example, and they buy a company. I mean, it could be a good thing, because if they buy that company and they issue shares to buy that company, and this company everything turns out to be a great deal, and the company that they acquire builds and pushes their business higher and higher and brings in more money, more profit, and more revenue, that's going to build up and actually give you more EPS, or earnings per share. If you don't know what EPS is, I have a video called What is EPS as well. You can check that one out as well. But the more EPS you get, the more earnings per share you get, then that means you're beating on your quarterly estimates. And that means your stock price more than likely is going up. So you're getting capital gains on the stock. So if the company that you own issues shares and they dilute your shares as an existing shareholder, it's not always a bad thing. Unless the company or the management team gets the money and they don't do anything to make the business better, or they end up losing the money some way or another through mismanagement, then that's when you have to look at a fundamental change in the company. You also have to think about or revisit whether you want to keep the company or sell the company, or keep the stock or sell the stock. Because there are some fundamental changes and some fundamental things that are going wrong. If the management team is not handling or managing business the way they need to, that is a fundamental issue. So it's not all bad when companies dilute shares, but it can be bad as well. So, but you do have to keep that in mind when you're purchasing a company. Again, when you talk about shares outstanding, you have to look at the shares outstanding, see how many shares outstanding they are, to understand how much of the business you're actually getting. If you buy a business that has a billion shares out there, right? And then you buy another business that only has 1 million shares out there, you're getting a lot more company. You're getting a lot more to have if you buy the company that only has 1 million shares out there. If you buy the company that has 1 billion shares out there, you're getting a very, very, very small piece of that company. Not saying that you don't have an ownership stake, but it's very, very small. So you have to keep that in mind when you talk about the shares outstanding, and also when you talk about share dilution and being able to see it and understand it, and being able to make an intelligent decision on whether this is a good thing for the company you own or a bad thing for the company you own. So you all, I hope this helped you in regards to understanding share dilution. I hope this also kind of helps you when it comes to understanding shares outstanding as well. So you all, please, again, smash the like button, subscribe to the channel if you like the content. I'm going to keep these videos coming because this is what I'm here for. I'm here to educate, I'm here to entertain and inform you in matters of the stock market. That's the reason why I started the channel. So you all hit the thumbs up, again, subscribe, and I will see you on the next video. Thank you. Bye-bye.